As we get older, we have to change things up. The same hairstyle that worked in our 20s just doesn't work in our 40s anymore. In the same way, our investment strategy has to evolve with our different life stages because each phase of life has different sets of responsibilities and circumstances. So let's get right into starting with an ideal investment strategy for the aggressive growth life stage, which is for most of us in our 20s. This stage is quite special because you have one of your greatest assets that you'll never have again in other stages of your investment journey, and that is time. Time, in the world of investing, is a secret sauce that can and will compound your wealth beyond your wildest imagination. Many people think Warren Buffett became one of the richest men in the world because he was an investing genius. Yes, he is definitely an amazing investor. However, his secret sauce wasn't just the fact that he was a good stock picker, it was the fact that he had been investing for over 70 plus years. It was those decades that took him from a millionaire to a billionaire to a multi-billionaire. And when you're in your 20s, you have that powerful asset, time, on your side. Thus, the reason I call this stage the aggressive growth stage from an investment perspective is because you have the time to take healthy risk, to be aggressive. So how should you approach your finances and investments during this life stage? Let's go over some here. 1. When it comes to your investment portfolio, specifically your asset allocation, be as aggressive as you can. If you have the stomach for it, I say go for 100% stock. A possible sample portfolio strategy would be 100% in a total US stock market index fund. A fund that represents pretty much all the publicly traded companies in the US, about 4,000 in total. Yes, it has quite a bit of volatility because you're exposed to all the ups and downs of the market, but you're also giving your portfolio the maximum potential for growth. 2. Focus on maximizing all tax advantage accounts available to you. These provide an immediate and guaranteed return through tax savings that drastically enhances your lifetime wealth. So aim to contribute as much as possible into your 401k, your Roth IRA account, and any other tax advantage accounts. 3. Ruthlessly prioritize investing in your career during this life stage. Focus on building specialized skills that command premium salaries in your industry, as these can dramatically increase your lifetime earnings. And to be honest, at this life stage, improving your skills and earning potential will likely have a far more impact over the long run than optimizing your financial investments. 4. Develop a strong savings habit. Learn to develop the valuable habit of living below your means, shunning lifestyle inflation, and embracing frugality. You won't see the immediate benefit. However, this will create an excellent habit that will function as a foundation for future wealth. And lastly, 5. Build up your financial education. Your knowledge about money will compound just like your investments. So learn about the stock market, different investment vehicles, and your own psychological response to money. Bottom line, the goal in your 20s, this aggressive growth stage, is not to get rich quick. It's to lay the foundation for inevitable wealth by combining aggressive growth investments with career development and solid financial habits. Alright, with that, let's get into the next life stage. Early accumulation life stage, which for most people happens in their 30s. Your 30s bring something new to the table. By now, you should have a higher income, a better understanding of your financial habits, and hopefully some momentum in your investment journey. But there's a plot twist coming. Life events. This is typically when the big expenses start rolling in. Think a wedding, children, and maybe even a home purchase. For my wife and I, all these events happened to us back to back in our 30s. Not only was it a very stressful stage in our lives, they came with a big price tag. Thus, in this stage, your investment strategy in a way needs to balance two competing priorities: long-term growth, as well as funding for immediate major life events. So let me share with you some recommendations on how to approach this stage of life from a financial and investment perspective. 1. You want to continue to maintain an aggressive asset allocation. I say maintain a 100% stock exposure. Yes, you might be a decade older than when you were in your 20s, but you still have 20 to 30 years until the traditional retirement age, which is plenty of time to recover from market volatility. So you want to accumulate as much as possible. However, you might find that continually investing is hard to do because, as we talked about earlier, there are so many other competing priorities. This is where the next recommendation comes in. 2. Automate your investing. Don't let the business of life lead you to take your foot off the pedal from investing. Keep on investing by creating a system that works without your constant attention. Establish recurring investments that increase automatically with your income. The truth is your 30s are likely to be some of your busiest years, juggling career growth and family responsibilities. Having your investments in autopilot ensures your wealth continues to build regardless of how hectic life becomes. 3. Allocate for family priorities. This is when major life purchases and family planning needs to be integrated into your investment strategy. Set up separate savings buckets for short to medium-term goals like home down payments. If children are in the picture, establish 5 to 9 college savings plans early. The power of compounding works for education funds just as it does for retirement. Don't forget to build an enhanced emergency fund that covers 6 to 12 months of expenses to protect against the increased financial responsibilities that come with a growing family. 4. Debt optimization. Debt might have jump-started your 20s, but that doesn't mean you need to hold on to them like your old girlfriend's sweater. It's time to let it go. If you're serious about wealth building, you don't want to have the weight of debt holding you back. So work to eliminate all high-interest debt from your life during this life stage. 5. Career advancement. If 20s were about establishing your career, your 30s are about leveraging your growing experience. Position yourself for promotions or strategic job changes that can substantially increase your income. You might even consider entrepreneurial ventures that utilize your now established expertise. Recognize that at this stage, your career remains one of your most powerful wealth-building tools. Your 30s will be one of the hardest phases of your life because of so many competing priorities. However, I'm confident, with focus and grit, you can power through it and will come out the other end not only stronger, but well-positioned for long-term wealth. Alright, but before we dive into the next life stage, I want to share something special with you. For those of you struggling to cut through the noise of flashy investment schemes and contradicting financial advice, I've created something I'm truly proud of, the Financial Tortoise community, and now it's open for waitlist signups. This community is your ultimate roadmap to mastering your money, systematizing your finances, and securing your family's financial future. So what makes this community so special? Inside, you'll find a structured path to building lasting wealth designed specifically for professionals who want steady, sustainable growth without the hype or unnecessary complexity. Exactly the stuff I talk about in this channel. The Financial Tortoise community includes personal one-on-one coaching sessions with me, where we'll address your specific financial questions and create a personalized plan aligned with your goals. Step-by-step member-exclusive courses on everything from developing the right money mindset to designing your ideal investment portfolio to minimizing taxes. Monthly live Q&A calls where we dive deep into key topics and keep you accountable. A private community forum connecting you with other hardworking professionals on the same wealth-building journey as you. Practical tools, templates, and resources that simplify your financial decision-making. And I'm especially excited to offer members a complimentary subscription to Monarch Money, a powerful financial tracking tool that helps you organize your accounts, track spending, and visualize your progress all in one place. This alone represents significant value, but it's just one of the many resources you'll gain access to. However, to maintain the quality of support each member receives, I only open enrollment a few times a year. So join the waitlist today at financialtortoise.com/community to be first in line when doors open next. Plus, as a special bonus for joining the waitlist today, you'll receive a free special gift delivered straight to your inbox automatically just for signing up. Remember, real sustainable wealth is not built overnight. It's created through a slow, consistent effort that compounds over time. Exactly what we focus on inside the Financial Tortoise community. Many members have completely transformed their financial lives, and with the right guidance and a clear plan, you can too. You deserve it. I would love to see you inside. Alright, with that said, let's get back to the video. Next up is the peak accumulation life stage, which typically occurs during your 40s. Your 40s represent another critical point in your wealth building journey. For most people, this decade is when your career earnings peak, your investment portfolio starts to gain significant size, and the power of compounding begins to really show itself. However, at the same time, your financial responsibility likely reached their highest point, perhaps supporting growing children, aging parents, and maintaining a home. This combination of peak earnings and peak responsibility creates a unique situation you have to manage with some finesse. 1. When it comes to your asset allocation, this is a good stage to start dabbling with some bonds in your portfolio. I wouldn't say too much, maybe 5 to 10% to get comfortable with holding them in your portfolio. However, this is not a must. If you have relatively high risk tolerance, 100% stock still works. The key is to recognize that withdrawal is now within 10 to 20 years, so you need to start gearing up for that, both mentally as well as with your portfolio. 2. Additional diversification. While you want to maintain a strong equity position because you still have decades ahead of you, this might also be a good time to consider additional diversification to even out your portfolio. Some popular investments apart from the stock market may be real estate or even an equity stake in a private business. 3. A sizable cash balance. As stated earlier, while this is for many people their peak earning years, it is also a time period where many financial responsibility come to head as well. Kids' education, aging parents, etc. Thus, you want to have a healthy level of cash to fund those activities. 4. Maximize peak earning years. This is often your highest income decade, making it crucial to capitalize on this earning power. Continue to maximize your investment contributions during this prime earning years, aiming for the highest savings rate. You could even consider pursuing additional income by leveraging all the career capital that you've built up so far in your career. 5. Lifestyle inflation management. I feel like the biggest threat to wealth building in this life stage is not the market. It's actually lifestyle inflation. As your income grows, especially as much as it does in your 40s, there's a natural tendency to upgrade your lifestyle. Bigger houses, luxury cars, expensive vacations. While some lifestyle enhancement is acceptable, you want to be strategic about which upgrades truly improve your life versus which ones just drain your wealth building capacity. Bottom line, your 40s represent the critical acceleration phase in your wealth building journey. You've laid the foundation in your 20s, build momentum in your 30s, and now in your 40s are when the real magic happens. When your investments begin working nearly as hard as you do. The key is striking the right balance between continued aggressive growth and prudent protection of what you've already accumulated. This decade is often when financial independence becomes not just a distant dream, but a visible, approaching reality. Alright, let's dive into a strategic transition life stage in your 50s, when you'll need to begin preparing your portfolio for the eventual shift from accumulation to preservation. Your 50s represent a pivotal shift in your investment journey. Retirement is no longer a distant concept, but something on the near horizon. This decade serves as a crucial bridge between your peak accumulation years and your eventual retirement. During this phase, you need to begin the delicate process of transitioning your portfolio from primarily growth-focused to one that can eventually support your lifestyle without a regular paycheck. Let's review some financial and investment strategies you should consider during this life stage. 1. Asset allocation transition. This is a time when you want to start gradually shifting your asset allocation from aggressive to less aggressive. But how? By adding more bonds. If you dabble with bonds in your 40s, this is a decade where you start making bonds a prominent part of your portfolio. A good target could be 90% stocks and 10% bonds, or 80% stocks and 20% bonds. It doesn't have to be right away because you still have a decade before withdrawal. You just want to get comfortable holding bonds. 2. Catch-up opportunities. 50s is also a time when many financial catch-up provisions are made available. So you want to take full advantage. Max out catch-up contributions in your 401k and IRAs, which allow you to contribute thousands more annually than younger workers. Also consider strategic Roth conversions during the years when your income might be lower, paying taxes now for tax-free growth and withdrawals later. 3. Income strategy. Explore opportunities to generate a reliable income stream. Consider real estate that provides rental income or building a bond ladder with staggered maturities to provide predictable income without excessive interest rate risk. 4. Be wary of the sequence of return risk. This risk becomes particularly important as you approach retirement. It refers to a danger that experiencing negative returns early in your retirement years, when you're beginning withdrawals, can permanently damage your portfolio's longevity. This is why holding cash, at least a few years' worth, is important so you can avoid selling investments during a market downturns. And 5. Career transition planning. Rather than planning for an abrupt retirement, consider how your skills and experiences might transition into less demanding but still fulfilling and income-producing roles. This glide path approach to retirement can ease financial pressure on your portfolio during the critical early retirement years while providing continued purpose and engagement. Bottom line, your 50s represent the critical transition phase when you begin shifting from wealth accumulation to wealth preservation. This doesn't mean stopping growth entirely. Most retirees still need substantial growth component in their portfolio. Instead, it means becoming increasingly intentional about risk management, withdrawals planning, and ensuring your nest egg is positioned to support you through what could be a 30-plus year retirement. Alright, finally, we've arrived at the wealth preservation life stage, which for many individuals begins in your 60s and extends throughout your retirement years. Your 60s and beyond represents the culmination of decades of saving and investing. This is when your portfolio typically transitions from primarily growing your wealth to sustaining your lifestyle. Your investment decisions are now directly tied to your daily life as you begin to live off your assets rather than your labor. The primary objective shifts from accumulation to sustainable distribution and preservation of capital. Let's review some financial and investment strategies you should consider during this life stage. 1. Sustainable withdrawal strategy. The traditional 4% rule is a starting point, but consider a more dynamic approach that adjusts spending based on your life's needs and market performance. Additionally, create a clear withdrawal hierarchy across accounts: taxable, tax-deferred, tax-free. This ensures minimizing tax impact. 2. Conservative asset allocation. Your portfolio should now reflect your need for stability. Consider a more conservative mix such as 70% stocks and 30% bonds. You can dial your bond allocation up or down based on your risk tolerance, but be careful of going too conservative. With potentially 30 plus years in retirement, you still need growth components to outpace inflation over time. 3. Income stream optimization. Maximize reliable income sources that can cover your essential expenses. Optimize Social Security claiming strategies, especially for couples where coordinating claiming can significantly increase lifetime benefits. If you like real estate, rental properties with their amazing tax benefits can play a significant role here as well. 4. Healthcare and longevity planning. Address the significant healthcare costs that typically arises in retirement. Ensure you fully understand Medicare coverage and supplements, as healthcare will likely be one of your largest expenses. Budget for increasing healthcare costs as you age, potentially setting aside dedicated funds for those expenses that will grow over time. This is where an account like an HSA could really come into play. 5. Legacy and estate implementation. Begin implementing your legacy plans while you can still enjoy seeing their impact. Consider strategic gifting to reduce the estate size if applicable, especially to help the next generation when they might most need it, such as helping grandchildren's education or adult children's home purchase. Review and update beneficiary designation regularly as family circumstances change. Bottom line, the wealth preservation life stage is about finding the right balance between enjoying the fruits of your lifelong savings while ensuring your money lasts as long as you do. Success in this life stage isn't just about the financial security. It's about using your resources to create a fulfilling retirement that aligns with your values and priorities. And there you have it. 5 distinct life stages with 5 different investment approaches. As we move through these stages, our strategies shift from aggressive growth in our 20s to a more balanced approach in our middle years, and finally to preservation and retirement. The key is recognizing which stage you're in and adjusting your approach accordingly. But remember that these are just guidelines. Your personal circumstances, risk tolerance, and financial goals should always shape your specific investment strategy. Thank you guys for watching and talking about investing strategies. If you want to delve deeper into investing and learn about some of my favorite lazy investment portfolios, please check out my video here. Until next time, all the best.